If you move to Australia from New Zealand and you still own property back home, there is something the ATO knows about your tax situation that you probably don't. Right now, on your current visa, you're likely paying zero capital gains tax on that property. But the day you get your permanent residency, that exemption vanishes and the bill that follows can be 5 or 6 figures. One client obtained PR, sold their New Zealand home and assumed their original purchase price would be used as a cost base. However, no valuation was obtained at the time they become Australian permanent resident. As a result, ATO assessed tax on the entire gain. The bill was far higher than it needed to be, and it didn't need it to exist at all. If you are still on a visa and holding New Zealand property, that window is still open. In this video, you will see exactly how the exemption works, the moment it disappears, and the timing decisions that can save you tens of thousands on a single sale. Most Kiwis in Australia assume the ATO has a claim on their New Zealand property from the day they land. It doesn't, and that misunderstanding is costing people tens of thousands of dollars on a single sale. When you move to Australia from New Zealand, you are issued a subclass 444 special category visa. It is automatic under subdivision 768-R, meaning anyone on that visa is classed as a temporary resident for tax purposes, providing you are not a permanent resident or citizen and neither is your spouse. Most Kiwis meet all three conditions without knowing it. As a temporary resident, you disregard capital gains on any asset that isn't a taxable Australian property. So, your New Zealand house is not a taxable Australian property, meaning you can sell it and owe the ATO nothing on the profit. No reduced tax, nothing. This isn't a loophole or a grey area, it's built into the law, specifically under section 768-915 of the Income Tax Assessment Act. But for most Kiwis who moved here without a PR, it's been quietly protecting them since the day they arrived. The problem is that almost nobody finds out that exemption exists until after they have already lost it. And once it's gone, it doesn't come back. The exemption doesn't phase out, it disappears at one precise moment. And most Kiwis miss it because they are focused on something else entirely. The trigger is the day you are granted Australian permanent residency or citizenship, or the day you marry or enter in a de facto relationship with someone who already holds it. At that moment, you go from temporary resident to ordinary resident. The ATO now has a claim on your worldwide assets, your New Zealand property included. Here is where it gets interesting. The ATO doesn't go back to your original New Zealand purchase price. Under section 855-45, when you stop being a temporary resident, your New Zealand property cost base reset to its market value on the day your status changed. Not the day you bought it, not the day you landed, the day your residency shifted. Let me put numbers to it. Let's say you bought a property in New Zealand back in 2018 for $500,000. You moved to Australia in 2024 and the property is now worth $900,000. You were granted PR in 2025 and got market valued for $950K on the same property. Finally, you sold in 2026 for $1.1 million. The ATO starting point is $950, so the property has a taxable gain of $150K. When you hold for at least 12 months after PR, the 50% CGT discount applies, bringing the taxable amount to $75K only. But here is what catches most people out. The ATO requires the gain converted to Australian dollars at the exchange rate at the time of each event. The currency movement can inflate or compress the number depending on timing, and the most people don't factor this in until after settlement. By then, the position is locked. If you don't get a formal independence valuation on an exact date your status change, the ATO will determine number for you. A backdated estimate years later won't survive an audit. That valuation is most important document in this entire process, and it's the one most Kiwis never get. Now, let's flip things around for a bit. Let's assume you are moving back to New Zealand after living in Australia as a PR or citizen. But if you have already moved back to New Zealand, you are walking into the most expensive version of this mistake. Under the 2020 main residence exemption changes, if you are a foreign resident for tax purposes, when you sign the contract, the exemption is denied entirely. It doesn't matter if you lived there for years, if you aren't a resident, when you sign, the exemption is gone. Imagine you bought your Australian home in 2021 for $700,000 and sell it today for $1 million. As a resident, you sign the contract before leaving. Capital gains tax, zero. But if you would have signed the contract as a foreign resident, you lose the exemption and taxed on the full $300,000 gain. Under current tax rates, foreign residents are taxed at 30% from the first dollar. While you might get a partial CGT discount for the years you lived there as a resident, you are still looking at an avoidable tax bill of roughly $60,000 to $90,000. On the New Zealand side, because you bought in 2021, you're likely outside the 2-year bright line period. However, the IRD still looks closely at your main home usage. If you are taxed in both countries, foreign tax offset can prevent you from being taxed twice on the same dollar. But they won't lower the high Australian bill you have already triggered. Never sign a contract to sell your Australian property after you have left permanently. The date on the contract is the date that matters. That single decision is the difference between a tax-free gain and a bill that wipes out a huge chunk of your equity. If you're finding this useful, subscribe. I break down cross-border tax strategies, and most of what I cover is the stuff you don't know. So, if you're still on your visa and holding New Zealand property, your tax position isn't set in stone. It comes down to 3 decisions, and everyone has a deadline. First, and this is the biggest, if your property has had a significant growth and you haven't applied for PR yet, the exemption is still active. Sell before PR is granted and ATO gets nothing. On a property that is doubled in value, that is a 5 or 6 figure decision. Once PR is granted, this option is gone. Second, the valuation. If you do get a PR, you need a formal independent valuation dated to the exact date your status changes, not a week later. Not a desktop estimate, a registered valuer, a precise date, a document that survives an audit. This set the ATO starting point. If you don't control this number, they will. Third, the 50% CGT discount. You need to hold the property for at least 12 months after PR is granted. Sell at 11 months and the taxable amount doubles. Your tax position on your New Zealand property comes down to a sequence: visa status, valuation timing, sale timing, contract date. Most Kiwis make these decisions without knowing they are making them. By the time they sit across from someone like me, the window have already closed. Here is what the first conversation with our team looks like. We review your visa status, your New Zealand property position, your cost base, and your exposure across both jurisdictions. You walk away knowing exactly where you stand, which levers are still open, and how much cash to set aside from the sale. Link is in the description. Book the call before you apply for a PR, before you sign the contract, before you move back. The cross-border tax traps I have just walked you through aren't unique to Kiwis. The same deemed acquisition rules, the same foreign resident traps, the same valuation mistakes hit anyone who moved to Australia and hold property overseas. If you or someone you know moved from overseas and still owns property back home, the tax exposure is just as real as mistakes are just as expensive. For example, I made a full breakdown of exactly how the ATO treats Indian property sales, including a withholding tax most people don't find out about until after settlement. That video is here. Thank you for watching. See you in the next video.